Tonight we are here to talk about energy and geopolitics. Is Japan ready to deal with the uncertainties? And as Josh said, we have an all-star panel to really take a deep dive into this question. So I'm going to do a light introduction of each of our three panelists, but I do encourage you to read their full bios. After you read their bios, you'll understand the depth of expertise that we have with us here this evening. So Go Katoyama. Go is senior consultant with Poten and Partners. Catherine Spector, who's research scholar, Center on Global Energy Policy at Columbia University. And Michael Tran here, who's in the middle, who's Managing Director of Global Energy Strategy at RBC Capital Markets. So what we thought we would do, just to sort of set the foundation for the conversation, is Go is going to start us off with giving us a picture of Japan, specifically looking at sort of the Japan energy landscape, especially between the years 2010 and today, to give a perspective of better understanding the energy security questions that we'll be looking at over the course of the evening.
All right, thank you. My name is Go Katayama with Poten and Partners. Again, thank you Japan Society for letting us co-organize this panel for the second year in a row. And every year we like to start off with a little bit of a picture, just per se, to see where Japan was in 2010 and where it was 2016. So if you look at your agenda, the name of speakers and the participants, I believe it's on page 4 of the packet. We just have one pager, it's not more than that, and I'll go through this very quickly, to just get a sense of Japan's energy security and like their energy security after Fukushima and how much they depend on global markets in fossil fuel and vice versa. So on the left side of the one pager, you have two charts, and this is the total primary energy supply of Japan from 2010 to 2016. So this is all historical data. On the upside, you have Japan's total primary energy supply, and you can see that gray at the top. That's nuclear energy kind of dimming out after the Fukushima accident and tragedy in 2011. And that used to produce about close to 25% of Japan's electricity mix, and that shut down after the 2011 accident. So basically, Japan's self-sufficiency of producing their own electricity and energy was about 20% in 2010. And after 2011, going on to 2015, without nuclear, that dwindled to about 7%. So Japan is a very large economy, depends on energy imports from around the world, are much more dependent on fossil fuel imports, predominantly oil and gas, after the Fukushima accident. So on the left side, bottom side of the one pager, there's a little bit more of the percentages. You can see that the large purple at the top increased along with the dark blue, and that's coal and LNG. LNG is liquefied natural gas. Japan does not have pipeline access around the world like the US or Europe does with Russia, so they have to liquefy the gas and ship it and bring it into Japanese ports. And this is something that Japan has very poor domestic resource of natural gas and oil, and so they depend a lot of it from international markets. So the fossil fuel dependency is about 90% as of 2016. This includes coal, oil, and gas, as you see there. Renewables are growing, but still a small percentage of the total primary energy supply. And again, this total primary energy supply includes everything that Japan does to get its motor working, from the industrial demand to power to commercial, residential, and agriculture. It's not just power. But obviously for nuclear is a power story. So we added one more slide to the right, showing you the decline of nuclear reactors from 2011. About 54 reactors were operating. And then after the accident, they were gradually shut down. And in 2014, there were 0 reactors. And then eventually in 2013, the Japanese government set up a new updated regulation authority that reapproves the restarts for all these reactors. So as of today, there's about a few dozen reactors that are approved, and about 9 reactors have restarted as of last year. And this year, no new reactors are going to restart. So about 9 reactors will be operating in Japan. So the future, the Japanese government really wants nuclear to be a baseload electricity source, and that is something that they want to have about 20% of Japan's electricity mix in the future, but that really depends on how much more they're able to restart. Otherwise, even if the population and the energy demand decreases in Japan, got to remember this high percentage of fossil fuel imports and dependency on global markets, as we'll talk about today, will be perceived to continue. So I just wanted to get that kind of a picture in everybody's mind before we start discussing about the future, what changed, what didn't about this year and going forward. I hope this is helpful. If you have any questions about this later, I'll be around, and so I hope this is great for now.
Well, I'm going to put you on the spot before you stop, is to, given the fact that you are, you're in the LNG space, can you kind of give us a picture in terms of what this meant for global LNG, the fact that, Japan had to really, the uptick in terms of its demand for liquefied natural gas was so high after 2011.
Yeah, absolutely. And the 2011 impact of the nuclear declining was about 10 million tons of LNG increasing in Japan. And as you may know, Japan started importing LNG from Alaska in 1969. So they've been in this game for a very long time. And their energy security around LNG and the infrastructure to import LNG is always more than double of their demand. So that regasification of importing that LNG, regasifying that into gas, and then sending it around to city gas and power demand, that was all prepared. But again, this was an interesting dynamic because a lot of the LNG that went to Japan because of that shock in nuclear came from Qatar, and a lot of that LNG in Qatar was supposed to go to the U.S. But what was happening in the U.S. was the shale gas revolution, so they didn't need those cargoes anymore. So Japan LNG imports are linked to oil prices predominantly. So a lot of it, in a high oil price environment, these Qatari cargoes were at a high cost. So the Japanese consumers paid a very high price for these LNG cargoes just to keep the lights on. But the infrastructure was in place. And that really led to the big jump in LNG market that year. But in the future, Japan's imports are capped at around 80 million tons. They're still the largest. China's coming in very quickly behind, now surpassing Korea at around 50 million tons. But Japan really still needs LNG to maintain its economy. So we think Japan's imports will stay around 80 million tons. And the U.S. supply is coming in. We'll have another discussion about that, which is really exciting times for Japan's supply mix as well.
Great. So Catherine and Michael, I'm going to turn to you to sort of give us a picture in terms of, given Japan's dependency on oil imports, how has what does the market look like for oil over these last few years, and what has been the impact on the Japanese economy?
Sure, I can take that. So thank you everyone for having us here. I think it's always very timely to have a discussion on energy security. And when I think back to this year, I think it's really important to have this discussion now because we're weeks away from just closing out the year. And what I think is really interesting and important is that when we think back to what happened in 2019, we saw some historic events play out, unprecedented events play out. We also saw a significant amount of supply disruptions in different parts of the world, right? So when you think about what's happened over the course of this year and how this is impacting different countries, we're at a point where over the course of 2019, we saw a significant amount of supply side outages, some that were transient, so places like Libya, or Nigeria, or even the biggest outage that we've ever seen in the history of the oil market when Saudi Arabia got attacked. But then we've also seen a number of structural supply side outages on the oil side as well, namely Iran and Venezuela. And some of this is, of course, due to sanctions from the US, foreign policy, et cetera. Now, when you think about how a major consuming country fits into this mix, so when Go was breaking down the fossil fuel consumption from Japan, what we see is that oil is still about 40 to 45% of the entire energy mix in Japan. So clearly, when you have a country that is wildly reliant on imports, supply disruptions really matter, right? Because prices are very volatile, historically speaking, based on supply side outages, not getting access to barrels, particularly when you're positioned in Asia where you're quite far from historically major oil producing regions. So I think this is really important in terms of how have all these major supply side outages really played out for prices, and then we can talk about how this plays out for major consuming countries. There's several things that I think are really interesting when we think back to 2019 and when you talk about how this impacts the Japanese economy. The first one is these countries are just, and I'm hoping to get into a lot of these details throughout the discussion, but just to preview this, several different thoughts here. The first one is when we think about how these countries deal with some catastrophic supply side outages or unprecedented supply side outages this year, we've seen a slight shift in terms of how the consumer views energy security. And what I mean by that is back in the spring, when you first saw the failed coup in Venezuela, you saw Trump pull waivers for countries buying Iranian crude. When you think about countries like Japan, historically wildly dependent on Iranian imports, South Korea, another country that is historically the world's largest importer of Iranian condensate. And then of course you think of China, who imports a significant amount from both of those countries, Iran and Venezuela. These countries started stockpiling a significant amount, grew their days of import cover. That changes how we think about the risk premium in this market, because when you think about that time period when Venezuela production started to take another leg lower and Iranian production took another leg lower, this was back in the spring. And as a result of that, between those three countries, China, Japan, and South Korea, we saw a significant amount of stockpiling to the tune of close to 900,000 barrels a day. When you think about what happened in a place like China, China historically over the course of this year would import 10 million barrels every single day. And what we saw back in the spring when the Chinese realized, well, it's going to be harder to buy barrels from different regions, I'm going to import a lot. So then they ramped up imports to 10.2, 10.4, 10.6 million barrels a day, only to put these barrels away in storage. And historically, when you get stock builds, that would signal, well, there's not enough demand, but China's backing up the truck, building a war chest of barrels. You saw it similarly in Japan, you saw that similarly in Korea as well. And what's interesting is, as we run through the spring and into the summer, when many of these major consuming countries already had a lot of inventories, well, what happened in the summer when we saw drones shot down, or we saw ships being seized in the Strait of Hormuz? Prices didn't really react. And I think part of that reason why was because so many of these consuming countries already built up a war chest. So I think that's really important in terms of how we conceptually think about some of these countries preparing preemptively for tighter global oil markets, so caring much more about energy security in a different way than historically was the case, perhaps. The other thing that I think is very interesting when we think about the risk premium and why oil prices did not spike despite a plethora of supply-side outages is places like the US, right? I mean, Go talked about the shale boom in gas. We saw something very, very similar on the oil side. And historically, what we've seen is this market has always been predicated on a few major pockets of oil supply growth, namely the Middle East, supplying significant portions of the world. And what we're seeing now is with the shale boom revolution, we're seeing that the incremental barrel that's coming onto the market is coming from a, let's use air quotes to say, less risky part of the world. So I think that's important in terms of thinking about energy security. And the last thing I'll mention before passing it to Catherine is we're wildly bullish on US crude exports. And we like to call the US Gulf the Walmart of the global oil market, because you can send, when people think about energy security, not enough people think about crude quality. And many people think about the US as just being a one-trick pony. We produce a lot of very light, very sweet oil here, but the truth of the story is that there's pretty wide range of different types of crude qualities that you could send to, in our opinion, meet or get close to meeting the needs of virtually every refinery on a global basis. So those are the three things I think that are very important in terms of reshaping how we think about energy security, particularly for places like Japan, Asia, China, in Asia. So I hope we can dive deeper into some of these topics over the course of the hour and elaborate on that.
I'll try. Catherine, anything you'd like to add? And maybe just to follow up with what many of the important issues that Mike brought up. But the question of price, right? We haven't seen a dramatic increase in the price, even in light of many of the disruptions and the sort of the growing uncertainties that we see in terms of oil producing areas. So.
Yeah, well, let me just offer my thanks as well to the Japan Society and to Poten for having us here tonight. I always sort of roll my eyes when people say, there's so much geopolitical risk in the market now. There's so much uncertainty in the oil market now. There are all these paradigm shifts in the market right now because really you could have said that at literally any time we all gathered together to talk about oil. But there are a number of things out there right now that I think are interesting and important. I think Mike did a great job of sort of looking at recent history and drilling down on what some of the really important variables have been over the last year. If I could just take sort of one step back and give a bit of a 30,000-foot view, I think there are a few themes that emerge. We've already heard about the U.S. shale revolution. I bet none of you have been to a talk about oil and gas in the last 5 years where that hasn't been a real centerpiece of the conversation, and there's good reason for that. It's a really monumental shift in how the oil and gas landscape looks with, we could fill hours here today talking about the implications of that. Just a couple that I want to pull out with respect to Japan and Asia in particular. The U.S. reduction in imports from other countries and increase our self-sufficiency on the oil front in particular. We've been self-sufficient for gas for a while. Our expected LNG imports never really took off other than the pipe gas we import from Canada. But as we become more self-reliant, it means that Middle Eastern oil goes disproportionately to Asia. Middle Eastern outages are increasingly an Asian problem. And rightly or wrongly, and I would just push back a bit on this idea that the United States doesn't have to care what happens in the Middle East or anywhere else in the world because we have our own oil now. I wouldn't go that far, and I would push back on that sort of thesis. But if we look at the U.S. reaction after the recent attacks in Saudi Arabia, they are perhaps not what we might have expected a couple of years ago. We might have expected a more sort of forceful intervention or some sort of policy, if not military response to that. And we really didn't see it. It was kind of crickets from Washington. And I think that does sort of beg the question of whose responsibility are some of these waterway security issues and issues like those if the U.S. is, rightly or wrongly, going to step back from that sort of policeman of the world type role. Another variable I would throw out there is, and again specifically with respect to Asia, is the way the natural gas market has changed. For a very long time, natural gas prices outside of North America were oil-linked formulas, and that kind of worked out fine, and everyone sort of rolled along with that. This is now becoming really a market in its own right, and I think that raises a lot of questions about how importers and exporters are going to look at the way gas prices. Another variable, a big theme I would toss out there is certainly in the U.S., but beyond the U.S., the wave that we're seeing towards populism/nationalism and how that may sort of alter the way that we think about everything from economic diplomacy to energy and other types of security. I think one lesson that we've all sort of learned from the recent trade wars is that certainly with the current U.S. administration, and I think with some other current administrations around the world, everything's on the table now. So certain rules of thumb that we had really gotten sort of comfortable with about, this is how diplomacy works, this is how negotiations work, really all of that is sort of up in the air. And I think when we talk about uncertainty, that really is something that a lot of countries, particularly countries that are heavily dependent on energy imports, really sort of need to grapple with. And without getting too sort of Twilight Zone about it, we can imagine a scenario where, for whatever crazy reason, the U.S. decides that energy exports are no longer in our best interest. Now you might say, how could that possibly happen? We're producing so much, we need to export in order to maintain our production levels. That's absolutely true, and I'm sort of throwing this out there more as a thought provocation than anything else. But everything that we sort of assume about international relations and diplomacy and economic relationships is now really sort of on the table and open for debate.
Wow. Okay, so I'm going to turn to you, Go. So in light of what we've just heard, what does it mean for Japan? How is Japan sort of thinking about hedging, and how is it thinking about both the risks that they've experienced this year that Mike and Catherine have illustrated, and what is it as they think about energy security moving forward? What are they doing, or what do you think that they need to do in order to enhance that energy security?
I mean, I look at gas every day, so I'm going to heavily focus on gas. But Japan, again, with the nuclear question mark, combined with the liberalization of power and gas markets. So these utilities have a lot of question marks on their demand. They don't know what their demand is going to be in the short and medium term without knowing how much nuclear is going to come back. So those big question marks, when you're procuring for supplies such as oil or LNG, most likely on the power would be LNG. These Japanese players have gone global. There's a liberalization, there's more competition domestically. The Japanese companies really value that flexibility. When that cargo is not needed in Japan, they want to be able to kind of swap that into a different market. And there's all sorts of, Catherine was mentioning these different types of contracts that are developing on the gas side that allows that kind of flexibility to happen. And the U.S. actually adds to that because the U.S. LNG is destination free, which is something that other markets didn't offer in the past. So, with the U.S. ramping up its gas exports, Japan does have a new source of energy, which enhances their energy security. And also, don't forget, Canada as a geography that's going to start up in 2025, bypassing the Panama Canal. It also adds a sense of different kind of energy security for that supply chain with shorter distance routes from Canada. So they're doing all of the above. And also, I would mention that Japan's domestic energy demand as a domestic market is declining, right? I think I read something like there's more grandparents wearing diapers than little babies in Japan. There's more cats and dogs than little kids in Japan now. So the demand's not growing. So they have to find opportunities outside of Japan. So at Potent, we do a lot of work helping Japanese companies with their analysis on what's going on outside of Japan, mainly in China, mainly in Southeast Asia. These are growing economies that require a lot of energy and cleaner sources of energy, more so as coal is the big picture in these regions, and they want to displace that with cleaner fuels, which could be natural gas or renewables. So they're doing all of the above, and the energy security with new sources of supply will increase as we go forward.
Great, thank you. So Catherine, I'm going to take you back to sort of the comment that you made, that you threw out about the U.S., for example, one day maybe not exporting. And I think probably many people in the audience have, if you've been following some of the political debates in the United States, that some of the Democratic candidates have actually threatened to ban fracking. Given the political landscape here in the United States, what do you see as being sort of a realistic view of sort of oil and gas exports moving forward?
Well, my baseline expectation would still be for growth, to be honest. I think it's a bit of an outlier sort of thing that something might interrupt them or slow them or stop them. I just think that there are more reasons to think about that risk now than there probably would have been when exports were first legalized. And I think that you're right that there's actually a sort of a bipartisan movement towards populism, and that manifests itself in different ways depending on party. But I think that it could play into this idea of a rethinking of what really is in the national interest of the United States, and that might not look the way it has for most of the post-war period. In terms of, you mentioned fracking, and I think that that is another really important sort of thread going through the U.S. political landscape right now, and globally, of course, certainly beyond the U.S., is a real sort of internalization of the challenges posed by climate change. And I think we're seeing this internalized not just by public sectors, but in corporate environments as well. And to the point that, there's been a lot of work done lately, maybe you may have seen some of the stories or reports on this, about the idea of peak oil demand coming in the reasonably near future. Not so many years ago, I was getting a lot of questions about peak oil supply, and that was the concern. Are we going to run out of oil? Now the concern is, are we going to run out of oil demand? And how might that timing line up with the type of investment that we need to see in oil supply in the meanwhile? So, I think that there are a lot of really sort of big existential questions here that really sort of flirt around the edges of energy markets, whether it's climate or a new sort of populist agenda in so many countries now.
Great. And Mike, can you give us a picture in terms of, the epicenter of demand is Asia. So, and you pointed out that, you've seen that over the last 6 months that China has been stockpiling, and I think the most recent data that China imported over 11 million barrels a day in October and November. So what does China's demand picture look like for considerations of the sort of the geopolitics of energy and its sort of moving forward?
Sure. I'll piggyback on Catherine's last comment about demand, and then we can pivot into the China idea, because you can't disconnect those two regions. The way to think about, just to paint the picture for the audience, when we think about global oil demand growth, over the course of the past number of years, so Go showed you a picture from this decade, so 2010 to present day, so we can continue to work on that timeline. When you think about global oil demand growth over the course of this decade, we've averaged about 1.2 to 1.6 million barrels a day over the course of the past 8 or 9 years. When you break that down to where the growth is actually really coming from, what you see is 60 to 70% of that growth comes from just emerging Asia. So this is countries like China, like in India, Thailand, Vietnam, Indonesia, etc. 60 to 70%. When you look at this year, by our analysis, our modeling, our math, we think that this year is going to be the first year that emerging Asian demand growth is going to account for 100% of global oil demand growth. And we think that's going to be the case next year as well. So Catherine brought up the idea of peak demand, and we can debate all night on, is that coming in 5 years, is that coming 10 years, 15 years, or 50 years? I think the key thing here is when we look at the major pockets of global oil demand growth over the course of this decade, you've had a few pockets. If you break it down even more, you have China, you have India, you have the rest of emerging Asia, you have Europe, and you have the US. Like I said, starting this year, I think that virtually all of the growth is coming from places like emerging Asia, China, India, and the rest of emerging Asia. So that just sets a scene of why China and India are just so important. And so to Go's comment about the aging Japanese society, when we think about peak oil demand, and Catherine knows this because she taught me this when we worked together, is when people talk about peak demand, what a lot of people don't realize or know is that in the OECD countries, you had demand peak more than 10 years ago, right before the recession. And because of things like Obama's CAFE standards, so it's corporate average fuel efficiency standards with vehicles becoming more efficient, et cetera, we'll just never get back to the pre-recession level in the OECD countries. And so, again, this is a scene-setting idea of just going to how important China is for the health of the global oil market, not just today or tomorrow or next year, but forever. So when you break this down, I think one thing that's really important is when we think about the Chinese economy. So if we rewind back 12 months, everybody remembers Q4 of last year when oil markets crashed and gave up about 40% of the annual gains. What's interesting is that a lot of people back then were talking about a trade war, China, US, slowing economic growth on a global basis. If you rewind the counterfactual on that, it should be a very different story because Chinese oil demand has actually been more resilient than people realize. But if you talk to many economists and you ask them, what's the state of the Chinese economy? They'll say, well, it's actually quite weak right now. You think about GDP growth slowing, you think about vehicle sales slowing. Let's put some math around this and try to break it down in terms of what it actually means for Chinese oil demand. So vehicle sales undoubtedly weak, GDP coming down. If we break down the vehicle sales number, we saw vehicle sales in China increase quite substantially virtually every year until 2017. And last year was the first year you actually saw growth in Chinese vehicles sold actually slow. It slowed by 1%. But the key thing is in 2017, you sold 29 million vehicles. Last year, you sold 28 and change. This year, given the broad Chinese weakness, you've seen Chinese vehicle sales down by anywhere between 12 to 17%. Rightfully, we should be looking at, well, a slowing Chinese economy, how does this play through for energy demand? I'm just going to throw this out here. Chinese GDP growth is going to slow. But for the 26, maybe 27 million people in China that bought a vehicle this year, or 28.5 million people that bought a vehicle last year, does anybody actually care that Chinese GDP growth, instead of being at, pick a number, 6.1, 6.2%, will actually come in at maybe 5.9%? No, the answer is no. Nobody will care because you're still going to drive. So I think the key thing here is when we think about the elasticity of demand, particularly as it plays out in terms of GDP impacting oil demand, elasticity is different depending on what part of the cycle you're in. So before I leave it at that, the other key thing that's really important is a lot of market analysts have gotten global oil demand growth wrong this year, and the numbers are much lower. And I'll end by saying that the US economy is doing relatively well. Vehicle miles traveled continue to increase, but gasoline demand in the US is actually negative. This year, you're down. So on one hand, you say, well, how is Chinese gasoline demand growing despite vehicle sales being down and the economy slowing, et cetera? And you think about the US economy, which is doing relatively well, you're just at a different point in the cycle. You've reached this efficient frontier where virtually unemployment is so low, everybody has a good job, everybody's getting paid a good wage, everybody is driving as much as you can drive right now in the US. So this is, I just use the US as a stark contrast to China because the elasticity compared to GDP is just different. You're just at a different point in the cycle. So that's why I think it's very important when we compare different countries, where you're at in the vehicle life cycle, where you're at in the oil demand life cycle. I think all of that is very imperative versus just purely looking at the economic state of each country.
That's great. Catherine, did you want to add something?
Yeah, I mean, I agree with everything Mike said because how could I not?
Maybe I taught you something.
I told them they were
We gotta
not
stir it
allowed
up a
to
little
agree
bit,
on
you know?
everything.
But just sort of to play devil's advocate, yes, China is a demographic behemoth, and yes, we have a growing base such that even when our rate of growth slows in China, it's on a bigger and bigger and bigger base, and it's still a tremendous amount of growth. However, I would also just, maybe suggest that there's a lot you can do in a command economy, right? So that you can't do in a country like the United States when there is a political will to do so. So China is exactly the type of place where we could see a very unexpected type of leapfrogging in any number of areas. And I would just sort of maybe keep that in the back of your mind that yes, when you look at these numbers, how could they not continue to grow powerfully? And I agree that's a base case scenarios, certainly, but I do think this is the kind of country where if we did have a technological breakthrough or whatever have you, a rate of adoption could just be so much faster than it could in a place like the United States.
If I may add just one thing on Catherine's point about the command economy, again, the energy markets really depend on the Chinese market to grow, and for all energy analysts, the China demand question is always keeping us up at night. We don't know. Everybody gets the China demand forecast quite wrong, and the answer is because it's a policy-driven equation, especially in gas. If the Chinese government decides they want to shift from coal to gas, as they did in 2017, that it happens. And a lot of people overshot the amount of conversions they were going to do in the residential, colder part of the northern China. In 2017, 2018, I believe like 9 million households were converted from coal to gas. And they ran out of gas and they had to go back to coal that cold winter. So the top-down government decision influences the continued demand of LNG in China, and that's a big question. And also compared to other countries like Japan, who depends on LNG for most of its gas demand, China has other options for gas. They have domestic production. They have the largest shale gas reserves in the world that they're trying to develop. As the U.S. pressures more on Chinese government, the Chinese are pushing much more weight into producing their own gas, as well as pipeline gas connections from Central Asia and the Russian Power Siberia pipeline. This is like a 35 plus BCMs per year contract coming in from the east side of Russia into China. So China has different options for gas. And for LNG, not to bring it back to the Japan equation, when you asked me about Japan's energy security, there's gas all over the place. People are finding more gas. People are finding more ways to monetize that gas. For the long term, for Japanese energy security, that's a plus because there's more supply than demand. Even with the Chinese ramping up, there's far more supply than demand. That's the theme of the LNG industry in the short to medium term. That's a plus for the Japanese importers and consumers.
But is there money for the projects to be built? I mean, is there enough money, even though there's a lot of supply? These are very expensive projects, and you're looking at a timeline of 20, 30, 40 years.
Sorry to take you guys 20, 30 years ahead of time, but yeah, I mean, capital is an issue, but more so than that, demand is an issue. How do you capture that incremental markets that Mike was talking about in Southeast Asia and China and India, and especially if you're the U.S. and you're trying to, there's 6 or 7 operating LNG plants today, and there's about 3, 4 more under construction, and then like 30, 40 other LNG plants under FERC review. Where is all this going to go? And the main question is marketing. I'm finding U.S. suppliers finding markets in Asia. And if you have the China trade war and you put 25% tariffs on your product out of the U.S., China's going to probably look at different suppliers for that. And the U.S. is going to have a problem when they're trying to execute more projects.
So you kind of went ahead in terms of the question that I was going to ask in terms of the possibility of kind of a decoupling, right? In terms of China sort of not necessarily being friendly towards taking U.S. oil and gas. But going to the U.S.-China trade war, which we're still talking about, right? I think we've been talking about it now for at least a year, longer.
Feels like a lifetime.
Feels like a lifetime, I agree. So how has this the not getting to a place where we actually have a deal, how has that impacted the oil and gas markets? And how has it impacted countries such as Japan that are so import dependent?
I mean, on the gas side again, it's definitely influenced the U.S. ability to execute these supply projects. And right now, it's a pretty pivotal time in the LNG industry because the market is growing. Oil grows at like 1% a year, but LNG market's been growing at double-digit growth since 2015. And this is driven by the ramp of Australian projects and the U.S. Gulf projects. These projects take about 4 years to construct, and they've been taking final investment decision in 2012, 2013, and these are starting to operate. But beyond that, for the second wave U.S. LNG projects, they really need that Chinese demand. So at this timing, one way or another, we've analyzed this and over maybe like 250 million tons of capacity. This is equally as big as the market a few years ago altogether. There's 20 exporting countries and 40 importing countries of LNG. That much amount of capacity globally is competing for this demand. And the U.S. is not the only player in the world. I mean, you got additional Mozambique projects, you got Qatari expansion projects. Qatar is the largest producer in the world today. And you got Russia also increasing their ambitions over to Asia as they have trouble transiting through Ukraine for gas pipelines. So it's a very supply competitive world, and in this timing to have these, this U.S.-China trade war, with the notion that this 25% added is a big problem for marketers, and it's a challenge.
Okay, thank you. And on the oil side?
Well, I mean, I think there are some sort of macro implications of the trade war and some micro implications of the trade war for energy markets. Macro-wise, this is a question of economic outlook, and I know there's some very mixed views out there on that now, and I won't pretend to have the sort of GDP forecast answer for you here, but I think we can certainly agree, or most would agree, that the trade wars are negative relative to the alternative on the outlook for economic growth. And all else equal, a negative outlook for economic growth is a negative outlook for energy prices. There's some other sort of micro issues here that are pertinent to the industry. Some of the materials, whether it is steel or I believe frac sand, and some of these other actual materials or hardware that are used by the industry are the costs are going up because of the trade war. So there are also some much more direct and micro implications as well. I would also just throw out there, we're not here to talk about commodities writ large. We're here to talk about energy, but certainly the impact on the agricultural markets is massive, and this is having a very big impact on American farmers. And while agricultural demand for oil directly, so the diesel you put in a tractor, is not huge, when you think about the sort of total food supply chain, so growing, harvesting, but then also storing, processing, and transporting agricultural products, that has a somewhat bigger energy footprint. So that one's maybe a little bit wishy-washy, but I think there are some of those micro things that we should also keep in mind.
Great. Mike, did you want to add?
Sure, I'll just be really quick on this. I agree with Catherine. I think that there's a lot of implications for sentiment in this market. I mean, Catherine wrote the book on the financialization of commodities, and commodities is an asset class now, just like anything else. It's just a chart to a lot of quant funds, black boxes, algo funds, and as a result of that, I think that there's less of a fundamental play as it pertains to oil, at least. This is also interesting because going back to my opening remarks when I talked about how 2019 was a really big year in terms of supply side outages on a global basis, and like we all know, China's been looking to diversify their energy sources, and ahead of the trade war taking place, China was ramping up imports of US crude quite significantly, and then you hit a point where trade war talk ratcheted up quite significantly to the point where China ceased to take oil, despite it being not tariffed, for a period of time. And it really forced China to start to look at other regions to buy oil from, right? And I mean, when you think about where China buys their oil from, it's a lot of different countries, but it's very centered in a lot of places as well. So, for example, when we think about countries like going back to Iran or Venezuela, that's 10% of where China buys their crude from. When you look at Russia, who had this issue with contamination of barrels on the Druzhba pipeline earlier this year, and had barrels offline for a significant period of time, that's about 15% or so. So between those three countries, you're looking at a quarter of where China generally takes their crude from, and then you add in Saudi Arabia, like suffered those attacks with Abqaiq, etc., and that's another 15%. So when you add all of those together, you're looking at 40% of where China generally buys their crude from suffered catastrophic outages at some point this year. So then you think back about to Carolyn's point about well, over the course of the past number of months, particularly since that tax, we've seen China ramp up imports to record levels in October and then record levels in November. And so it's interesting in terms of if it were not for this trade war, if there wasn't for sentiment, what would oil prices look like? What would trade look like? Because China could certainly take more barrels from the U.S. if they wanted to.
So maybe going to oil price, especially since OPEC met last week in Vienna. And so OPEC Plus agreed to cut 500,000 barrels in addition to the 1.2 million that they had already committed to. And I think this goes out through March of 2020. But since Friday, we've seen a slight uptick in the price. So is the deeper cut actually having the type of impact that OPEC Plus hoped it would, or will it eventually, when it actually starts to sort of really hit the market and supply?
You want me to take that? I think at a minimum, when we and the rest of the street looks at what oil balances would be forecasted for the first half of next year, oil balances would be pretty soggy if OPEC didn't cut deeper. So just to throw some numbers out there, we think over the course of the first quarter, you're oversupplied by 200,000 barrels a day. In the second quarter, you're oversupplied by 800,000 barrels a day. So that's about 500,000 barrels a day over the first half of the year. So with the additional OPEC cut deeper, 500,000 barrels, at least through the first quarter, you're able to absorb some of the additional production growth that's coming on right now. So places like Guyana, where there's new finds, or Johan Sverdrup, which is a field in the North Sea that's coming on. And by cutting deeper, you're able to absorb these barrels. So oil prices don't need to go materially higher by tightening the market. But what I think is, at a minimum, it just puts a floor into this market. It shows the managed money category of traders, which is speculative length in the market, speculators in the market, that at a minimum, OPEC is here to really play ball, to really solidify a floor. Because if you rewind a week and a half ago, market consensus was that they were just going to roll the 1.2 million barrel a day cut over. So I think this is really important in terms of oil prices are at a point where they don't need to go that much higher to hit some of the fiscal break-evens for some OPEC countries. Some other countries may need much higher prices, but when you look at Brent prices in the low to mid 60s, I think that makes a lot of sense for consumers and producers as well.
So just to throw it out, because earlier we were talking about tweets and some of the impact that Trump has had when he tweets out in terms of sometimes making the price go up and price go down. So if the price went up, let's say above 70, do you think then that would cause a reaction and President Trump would respond and saying that the price is getting too high, that OPEC needs to bring it down? Given the fact that we are in a, is quickly entering an election year?
Yeah, I think timing really matters, because if you rewind a year, roughly this time going to the OPEC meeting, midterm elections really mattered for the Trump administration. And then if you fast forward a year, you're heading into the 2020 election. So I think that really matters. I mean, it's tough to quantify, but if you were to run the math on correlations between oil pricing, timing, and a Trump tweet, you probably find a relationship that makes some sort of sense. So I think from that angle, timing matters much more for Trump, because at the end of the day, it's just all about re-election. I know Catherine has a number of comments on this as well.
Yeah, I mean, without trying to get inside Trump's head, I think that as a generalization about the United States, it used to be for any American politician, the lower the better on oil prices, right? The lower the better, what else could you possibly want? That's not really the case anymore. Now the United States, from a policy perspective, really does kind of want more of a Goldilocks price. So not so high that it's painful for consumers, hurts the economy, hurts consumer confidence, things like that, but not so low that it undermines our own industry, because now we have a man in the race here too, so to speak. So which of those constituencies Trump may have in his ear on any given day is, I think does depend on timing. Are we talking to his base a month before the election? Are we talking to donors 6 months before the election? I don't know. That I think is the question. But there's not sort of a single strategy here from the U.S. perspective broadly anymore. On the topic of tweets and price correlation, I guess just one sort of subtlety I would throw out there. I don't believe that there's a fundamental, or that's the wrong word. I don't believe that there's a real link between Trump's tweets and price. I think there is a link between Trump's tweets and rules-based trading, by which I mean algorithmic trading and other similar styles of systematic trading that take certain rules or keywords or what have you and trade in an automatic way across asset classes, so not just in commodities, but across asset classes. So, sometimes I hear people say, well, Trump tweeted this, so, we have a paradigm shift in U.S. policy where now the U.S. government will intervene in markets. No, we don't. We have a market that is very much dictated, at least in terms of short-term price movements, by this burgeoning and growing class of rules-based traders. And there are now algorithms that attempt to reverse engineer other algorithms, and algorithms that try to reverse engineer the reverse engineers. So all of these things are taking Trump tweets and feeding them into a giant machine and spitting out a trade. And I think that is a different animal than people actually interpreting a Trump tweet as fundamental policy that will alter the way that oil markets behave, which is a totally different thing.
Since we're talking about tweets, I'd like to add, on the LNG side, it's relatively to oil a little bit more tweet-proof because, of the market last year, about 70% is long-term contracts. So these are closed-door, more than 10, 20-year contracts that are in place. So Trump can't really affect too much of that. But on the spot side, he could, probably, because a lot of the LNG is priced to oil, could have an impact there. But I'd like to add, the dynamics of oil and gas a little bit different, as a lot of the investments and the infrastructure decisions were made, way before when Trump was president. And even though he was at the Cameron LNG facility, that was, that took FID during the Obama era as well.
Go, since you're talking about LNG, can you just sort of give us a sense in terms of how LNG prices have changed, especially over the last decade, as it relates to Asia? Because we've seen a pretty dramatic change in pricing between, for example, Asia, Europe, and North America.
Yeah, and this was basically Japan and Korea. A lot of the LNG was linked to oil prices, linked to Brent, and there would be a slope attached to that oil price. And based on market sentiment of the players and how they feel the market supply demand is, would agree to that slope percentage to Brent. There'd be different kink points to the upper and lower limit to that number, but that was basically how it was linked, because Japan was predominantly producing its electricity from oil. And that was a big problem after the oil shock in the 70s, and they wanted to start diversifying away from that, which they did with nuclear and other sorts of energy. But now Japan has other sources of gas linkages, and this is predominantly thanks to the start of the U.S. projects. And the U.S. gas market is a lot more dynamic than what you see in Japan, as you have the highly sophisticated dynamic Henry Hub market, where you have pipeline access and over hundreds of gas hub points. The price of gas you pay is different in different cities, and supply-demand matches. And so Japan, we don't produce our own gas. You have to import everything. More than 70% of the country is mountainous. Pipelines are very difficult to build, so you're at the mercy of global LNG prices. So what happens with Japanese average LNG prices? It really depends on how much of oil linkage, which is still predominant because U.S. exports just started ramping up in 2016. And as you start to see more projects start ramping up, and a lot of the Japanese players were already in the U.S. projects, and then you start to see that Henry Hub linked LNG come into Japan, the dependency, as I may put it, on the Henry Hub exposure will increase. And that exposure and comfort level is very different based on different utilities around Japan, and that's something nobody really has an answer to. So you just want to try to diversify as much as you can geographically and price point wise, and that's really what energy security in Japan is. Because sometimes Henry Hub prices might go up, and the supply chain to Tokyo Bay through the Panama Canal might be very expensive. Let's say in a cold snap, or if we export too much and Henry Hub prices jump up. Then it's like, oh, I should have just stuck to that oil price thanks to the US putting all that supply out there and pushes down the price. So the best way is to just diversify your mix as much as possible. So that kind of goes back to your point about the dependence on the US now, relatively. Is less riskier than the Middle East, but then there's a whole new set of risks that you have to think about when the U.S. becomes a larger exporter in the world.
Yeah, and I think that we've all sort of been lulled into a bit of a coma around gas prices because we haven't had a really good gas price spike in a while in North America, although we kind of got there for about a minute last winter. And I think that was a bit of a wake-up call. I think there's a whole generation of gas traders that have never seen $5 Henry Hub, and it can happen. And
how old are you?
Ooh, thanks, bud. Old enough to have seen $5 Henry Hub. I won't go any higher than that, or I'll really date myself. But I think, again, just a sort of a provocative thought exercise, imagine a scenario where we're going into winter in North America with low gas storage, and we start cold and have record cold in every region, and we see a spike to $6, and something that no one has thought about in years is suddenly on cable news, and you hear about old ladies freezing in Chicago and all of this. Does that sort of change the psyche? And if the next headline after that is that X number of LNG cargoes departed last week for China, you can see how the optics of that might start to look a bit different. Natural gas prices have never had the sort of emotional resonance for Americans that oil and specifically gasoline prices have, but you can imagine a scenario where it comes into a slightly different focus at a higher price point.
So before I open it up to questions, I have another question for all three panelists. Since we are in COP25, right, is going on right now in Madrid, and Catherine, you spoke earlier about sort of climate change, and I know I know Mike, you and I have had the conversation about the kind of the growing importance companies have around environmental and social governance issues. So I'm just sort of curious to get your take in terms of the conversations that you're having and how you see this playing out over the short and medium term, and maybe implications for geopolitics.
I guess just a couple of sort of tipping point signal headlines that I've seen lately that I thought were quite interesting. We know that environmental and social governance, or ESG investing, has grown by very large percentages over the last decade, but from a very, very tiny base, so still sort of peanuts in the greater scheme of things. We know that many corporates are now, hiring full-time sustainability folks to come up with a climate plus strategy for the company. Some might call it greenwashing. Sort of depends on the company how earnest some of those efforts are. But when we think about where capital comes from these days, a lot of it comes from some of the big institutional sources. So big pension funds, sovereign wealth funds, central banks, places like that. And we're starting to see a shift in what they're doing. So when you look at sovereign wealth funds, they are now, I think, 2/3 of them have incorporated some sort of ESG filter or lens to their strategies. 20% of central banks now do, and that's up from 10%, I think, a year or two ago. And one other sort of signal to me that I thought was pretty interesting is that the flagship emerging market debt index, the MB, now has a version with an ESG filter on it. So think about that for a minute. There's a scenario here where if enough money shifts, the ability of countries to access debt could depend on their ESG policies. And most people feel as though the G of ESG, the governance part, in most investable places has sort of gotten to a reasonable level, and that leaves the E, essentially, and that's the big, hard, expensive part, realistically. So I think we're now sort of getting to the point where pretty soon we're going to be talking about a pretty serious divergence of capital. And that's where I think this sort of starts to get interesting, and we have to then go sort of beyond the greenwashing strategies that maybe we've seen so far into a sort of a really serious reassessment of how capital markets will work in this world.
That's great.
Maybe I'll build on that and take it to, so use that capital. Think about if you're following the capital into like renewables or cleaner burning or cleaner forms of energy, and then tie this into the energy security dialogue we've been having today. What I think is really interesting is when you think about the question of, is the energy world more secure today than it was yesterday, or will it be more secure tomorrow than it is today or yesterday? It's interesting because when we had the dialogue about peak oil demand, and again, I think we can all debate when peak oil demand is coming. I don't think, going back to Catherine's point about, well, we flip-flop from peak oil supply to 10 years later talking about peak demand. I think it's inevitable in terms of when we see, or the idea that peak demand is coming. So if we think about energy security and how all of this ties in with, at some point, more and more capital funding into renewables and think about the energy transition, is this whole idea of when we conceptually think about the oil market, going back to the idea that historically there's a few major producing hubs supplying a pretty vast world of consumers. Anytime you have a barrel, so call it like LNG or call it oil or anything that travels as an energy source, anytime you have to travel from point A to point B, you increase the risk of price volatility because of supply disruptions. You have tankers that may get seized by pirates, or even simply just the logistics of a tanker showing up late because of violent weather impacts energy security to some degree. So if we believe that to be true, then the idea that as we move to a world that is more reliant on renewables and every country is going to be moving at a different pace, the way I think about renewables is you don't travel. So where oil is, or where energy is produced from a renewable form is largely consumed in that same broad region, at least until we figure out storage, et cetera, and how to transport longer distances. So when we think about that, I think we're moving towards, as the capital comes in and we move towards this energy transition period, closer towards a world that is more reliant on renewables. I think that also changes how we think about energy security as well, because you just take away the risk of moving cross Atlantic or cross Pacific on an oil tanker. And it's much more of just-in-time energy rather than if you have a 45-day voyage from the Gulf Coast to any other major continent. It just leaves much more room for supply disruptions.
That's great, thank you.
Just to add a few more comments on the energy transition picture and how Japan may fit in. I mean, we forget that about 80% of the world's energy is still fossil fuel. Maybe 35% is coal. Maybe 20 years ago it was about 90%. So we reduced it by 10%. And energy transition takes a long time. We went from wood to coal to gas, nuclear, over 100 years. And so a lot of people have all these goals about 2030 and 2040, but we forget about what's going to happen in the next 5 or 10 years. And that's where we have to take a back seat and say, what energy I learned this from you in your class. Nothing in energy is perfect. The technology has positive and negative externalities everywhere. How do we, manage that negative externality as much as possible and have a, much more energy secure policy is definitely the way forward. And, I definitely hear the name Greta Thunberg a lot more in my meetings these day and age. And for the natural gas industry, the golden age of gas was something that everybody was excited about. The IEA came out with this big report, and it felt like every gas conference felt like that transition was getting shorter. But when you think about the short to medium term energy mix, the gas has to play a role. And so a lot of the end markets that depend on this growth in Southeast Asia and China really depend on switching from coal to gas, because a lot of the coal is not going away. I mean, the Southeast Asian countries are building new coal plants, because the cost outweighs the benefits of the environment. And those are some hard decisions that will, get built in the short to medium term, and it has to be balanced with also the fact that their population and demand is growing, right? Because there's about 7.5 billion people on this planet, and going to 9 billion, and 1 billion today don't have access to electricity. So it's a pretty energy-hungry world that we live in.
Okay, so lots to think about. I want to open it up to the audience, and I hope that you all have some great questions. Please state your name and affiliation, and happy to take questions. And if there's a particular panelist that you'd like to direct your question to. I will start calling on people. So I see, yes, right in the back. Thank you.
Good evening. My name's Ed Ludwig with Merit Capital. We do financial advisory. My first job was energy policy, a few miles away from 3 Mile Island in Harrisburg a year after that. So that goes back a few years. This is about energy security. And, the U.S. we have flows going in and out of the country, but I think we're energy independent now. We're a net exporter. But in terms of Japan, if you look at this chart on the bottom left, it looks like beginning in 2010, Japan was about 20% domestic between nuclear and renewables, and that's now shrunk dramatically. And then you look at the chart on the right, which I found kind of striking. I would have thought that by now most of the nuclear plants were back online. In the US, nuclear is viewed as really good now. When I was in college, people were storming nuclear plants trying to get them shut down. It was the worst thing. It's like where plastics are going to be. If you look at the UN down the street, that's the next big crisis. But in the US, the big crisis is climate change. So looking at this chart on nuclear on the right, it's very striking that Japan has not ramped back up its nuclear fleet, given that nuclear does not emit any CO2. And in the US, we're now extending nuclear licenses, which initially were about 20 or 30 years. Last week, a utility in Florida got, I think, an 80-year license. So this is not directed to any particular panelist, but this panel is about energy security, and it looks like Japan's becoming less secure, and maybe nuclear, renewables is a part of this, but it doesn't seem to be moving the needle much. So I'm wondering what the panelists would say to that.
Excellent. Thank you so very much. Would you like to start?
In the beginning of the panel, you're exactly right. Japan's self-sufficiency, it was 20% before Fukushima, now it's 8%. So that's definitely gone down because of nuclear. And the nuclear restarts also is a concern in the LNG industry, because that would dampen LNG demand in Japan. It's a very long process. This is a nuclear regulation authority under the Ministry of Environment with very stringent requirements the utilities have to meet to get this restarted. And once they get the NRA, Nuclear Regulation Authority approval, the local government has to approve this as well. And the local sentiment in Japan, I don't know if anybody has a real clear answer to this. It's still, I would say it's still up for grabs. There's a lot of people who still remember the tragedy in 2011, and the nuclear scare is actually not only in Japan, but even in Korea or in Thailand, is spreading all over, that region. And so, There's about 9 reactors restarted, and maybe 3 times more under review. Of course, the ones that melt down will never restart again, but Japan's faced with a very difficult situation to be self-sufficient as much as possible, and the nuclear is a big part of that. And Japan's energy policy from 2016, the basic energy policy, states that nuclear is an important part of their baseload electricity, along with coal. And so it will maintain about 20% of Japan's nuclear, that is, of electricity mix in 2030, along with other mixes, and do as much as renewables as possible.
Just as a quick follow-up, in 2016, I took a group of students to Japan where we're actually looking at energy security in the country 5 years after Fukushima, and we had, a number of different meetings. And when we were at the ministry, we heard sort of 2 different versions. One that that the reactors were going to come back online, and one person that we spoke to said, well, the government wants the nuclear reactors to come back online, but the public sentiment, as Go pointed out, is quite negative. And it was actually taken to the local courts. So what you see in terms of where a number of these reactors have not restarted is because of opposition, local opposition, that they've been able to really use courts to keep them closed, from what I can understand.
And if I just may add one more thing, those 9 reactors may actually be lowly utilized, and actually some of them might be shut down because there's another requirement whereby when they apply for the restarts, these facilities have to have a anti-terrorism facility. So when a terrorism type attack happens, there's got to be a separate facility to manage that situation. And a lot of the utilities are delayed on this construction. So the regulatory authority are going to wait until, they're going to shut it down again until these facilities are built. And based on the utility, this could be a year, 2 years shutdown, even though they got these restarted. So the self-sufficiency number of 7-8% might even go lower in the short to medium term as well.
Great, thank you. Some other question right there in the back? Oh, hello, Rachel. Hello, nice to see you. Rachel Ziemba
Nice to
from
see you
Ziemba
guys.
Insights. I'll introduce you.
Thanks, you saved me time. Nice to see you guys. I had a comment and a quick comment and a question. Thanks, this is a great summary. One was, the comment is just something that I took away from some recent ESG events here in New York, was that there seems to have been a shift in a lot of the Japanese asset managers around ESG, particularly in the last year. Partly the JPIF obviously has long been thinking about ESG dynamics, but the news and entities like Nikko Asset Management and the like. Japan obviously is a major source of capital to, across all asset classes, but especially like China and like South Korea, to coal plants and natural gas plants and across the board. I guess the question mark is, does this turbocharge? The comment is, Japan seems to really be defining ESG in a way that's maybe slightly different from the Europeans. Are you seeing any evidence of that? And the question was about India. I think you guys talked about China really in depth and really good dynamic. India, of course, big, energy demand across the board, all of the above. But India's been a country that not only has had schools shut down in Delhi for several weeks over air quality, that has had downward surprises on growth revisions and the like. Are you having to, as you think about oil and the energy mix demand growth, are you having to revise down your short-term estimates on India? Or is this actually maybe a positive for the slightly less polluting examples? And thanks again.
Thanks, Rachel.
I can talk quickly about the renewables picture. And Japan before Fukushima I think it was like solar and wind, taking away hydro, was less than like 2% renewables with its power mix. So they're coming from behind. And after Fukushima, the policy shifted more towards renewables, and that's exactly what they're doing. But in terms of what we can see in the future in Japan, this liberalization of power markets really incentivizes price and cost of electricity it produces. And it automatically, when competition between the regional monopolies of these utilities and these new players came around, cost became a big issue. So what happens was coal plants started to increase because that was the cheapest way to produce electricity based on the competition that was created after Fukushima. So unfortunately, the policy of liberalization and competition was supposed to bring cheaper energy sources into Japan, but what happened was coal sort of increased, and that's why you're going to see an uptick in coal in Japan. But the longer term, I absolutely agree with Rachel, and there's a big momentum towards renewable solar and wind, absolutely in Japan. And a lot of Japanese players are making big moves outside of Japan as well in renewables.
So I can answer the second part of that question on India. So Rachel, your question was, look, are we having to revise our Indian demand forecast lower? I think the answer is unequivocally yes. I think, so when you talk about how we spent a lot of time talking about China, let's talk a little bit more about India. I'll answer that question on India by talking a little bit more about China to set the scene and then bridge it to India, because I think it's really important in terms of giving everybody a conceptual view of how these countries are different and how they're moving at different paces. So Catherine's point about a command economy, about Xi Jinping being emperor for life now, and he can really do whatever he wants from a policy perspective because he doesn't have to go through an election cycle. Going back to the idea about Indian vehicle or Chinese vehicle sales like we were talking about, when we talk about China being a very bullish catalyst for the oil market, there's also very bearish implications when we think about China from a government perspective. And so when I talk about gasoline demand growth, what could significantly change the landscape of how we think about China grows its oil demand is government policy, in the sense that China also leads the world in terms of electric vehicle sales. Also electric bus sales. You have a significant portion of certain cities that are entirely electric on a bus perspective. So my main fear for global or for Chinese oil demand or gasoline demand is not necessarily if a subset of the population, right now it's about 5 to 6 to 7%, goes out and buys an electric vehicle. But my concern about peak oil demand is if you essentially have policy put in place where you have major cities like Shenzhen who go completely electric on a mass transit scale. And then you'll think about, well, the demographics of all the people that you thought were going to buy an electric vehicle no longer have to because their entire transit system is plugged into the grid. And oh, by the way, the entire taxi system is also electric. So with that background in play, a lot of people draw a lot of parallels between China and India. India can't do that, right? Because there's an election cycle. Now, with an election cycle, what you often do is you try to cater towards things like pollution, like Rachel said. So if India wants to be similar to a European or a Scandinavian country in terms of we want to get off of internal combustion engine vehicles by a certain year, it's extremely difficult to do that, because when Go talks about how there's 1 billion people on this planet that don't have access to electricity, well, guess what? There's a significant portion of that 1 billion people that reside in India. So I think that's really important, just to set the scene for how we broadly think about India. If we take this back to today, and your comment about Indian demand, do we have to revise that lower? The answer is yes, and the reason why is because the economy is struggling in a pretty big way. So what's happening right now, and I'll tie this back into how we think about Japanese energy security and Asia energy security, is this idea that refining margins in Asia are really terrible right now. And why is that the case? Well, that's the case because the Indian economy is actually really weak. Historically, what's happened is Indian refiners would run, they would run and make just enough gasoline and just enough distillate for their own domestic growth, for demand of these products. But what's happened is, with the slowing of the Indian economy, India, over the course of the past month, has been exporting distillate or diesel at all-time record levels, and as such, you're completely crushing refining margins in the region. So the answer is yes, we're revising those numbers lower, and everybody is. What you're seeing is that Indian distillate demand has been negative for the course of the past 3 months. That's important. Now, let's just spin this idea a little bit further and think about how does this tie into how countries like Japan or Korea, many of these countries that don't have a lot of domestic energy sources, and how this could potentially play out. You have a situation, and we'll tie this back to Catherine's comment about a command economy as well. You have refining margins that are really, really weak right now in Asia. And as a function of that, who can continue to produce barrels if you have negative margins? If you have negative margins, this means that running a refinery is a money-losing proposition. Well, guess what? China can, because you're a command economy. What if we go through a prolonged cycle and China's still building and bringing on new refineries? And as such, if you overbuild that, you're exporting a lot, you're essentially swamping that market, you could have negative refining margins for a prolonged period of time, a cycle, 6 months, 12 months, a year, 18 months, etc. And as a result of that, if China's trying to make a play on an economic basis or energy security basis, those refiners can run at negative margins for a long period of time because the government will just make you eat the margin. But who can't do that? Well, it's refiners in Japan, it's refiners in Korea, these non-state-owned refiners that are essentially owned by the private sector. You can't, if you're not economic, you can't run your refiner. We've seen scenarios like this play out before where refining, of course, is a very cyclical industry. If you bankrupt a number of refiners in the region, this has massive implications for how we think about energy security, because many of these countries like Japan and South Korea will just have to feed themselves hand to mouth in terms of taking and relying on refined product exports from places like China. It's a scary thought, because when Go talks about how, from an energy security purpose, domestic energy only makes up now 8%. If you have issues like that, you're already importing crude right now, but if you're in the future no longer importing crude because you're much more reliant on refined products, you don't even get to keep the economic rent at home.
Okay. So lots of people taking notes there, Mike. So thanks. Leila?
Hi, Leila Nouri, New York Energy Forum. So Catherine mentioned that the growing geopolitical risks in the Middle East is becoming an increasingly Asia problem. Given that we saw earlier in the summer Shinzo Abe was in Iran, and simultaneously there was an attack on an oil tanker with cargoes going to Japan, do you see them playing a more proactive foreign policy role in the Middle East moving forward?
Well, that might also be a question for Go, but I think they must at least be thinking about it, and China as well. And I think, we all know that China and Japan have typically approached diplomacy in very different ways, but both countries seem to have stepped up their presence, things like visits and things like that to the region. And I think one word that we've only mentioned, I think maybe twice this whole evening, is Russia. And I think that I have Russia on the brain from listening to impeachment hearings all week. So to hear Russia not mentioned at all for like 2 hours is nuts. But I think that's just sort of another party in all of that we sort of have to think about where everyone's interests lie. But I think that the U.S. not having a stronger response to what happened in Saudi Arabia as well a couple months ago, was it already? That was also probably a bit of a wake-up call.
Can I build on that? I think that this is a really excellent question. And the reason why is because when Catherine talks about the tax on APCAC, Saudi Arabia, that happened in mid-September, we've seen significant ramifications in terms of the ripple effect as it pertains to energy security. And many of you will say, look, Mike, you're just essentially talking about how we saw the biggest supply outage in the history of the oil market, even though it only happened for a short period of time. That's true. But one thing that I don't think enough people have thought about is when the Saudis lost a significant amount of production, almost 6 million barrels a day, that essentially collapsed the amount that they can essentially continue to meet export commitments to key consuming countries. I want to highlight 2 things here. Number one is the amount that went to key demand growth centers like China. and the amount that went to less prioritized clients or countries like Japan or Korea. So for example, again, going back to the idea when I talked about post-APCAIC attacks, the Chinese essentially had October and November at record high imports. When the Chinese did that, well, how much did they take from Saudi Arabia? Generally, China takes about 1.5 to 1.6 million barrels a day from Saudi Arabia. Well, in October, guess what they took? They took 2 million barrels a day, the most they've ever taken from Saudi Arabia. And you say, look, during a time period when Saudi exports were truncated, you sent a record amount to China, and guess what? Well, they sent 25% less to South Korea. So when you think about the prioritization of energy security, that also rests within some of these key Middle Eastern countries as well, right? In terms of, well, why would you prioritize China? Well, because it's the biggest demand growth country in the world. Why would you prioritize a place like India? Well, because it's the second biggest demand growth country in the world. And like I said, OECD countries' demand is on the decline. So it's interesting in terms of thinking about the bifurcation within certain events that have played out that's changing how we should be thinking about energy security and diplomacy.
Just to throw one more variable in, because you mentioned Abe specifically in Iran, I think that a lot of these countries would also probably approach multilateral sanctions very differently now. It was sort of a bit of a unicorn, the way that, with the, I'm going to forget the acronym, but the Obama, there you go. The way that got so much signed on, even from countries like Russia and China, and strict adherence. And it's very hard to see something like that coming together again in today's landscape. Why add another outage essentially to your list when you are increasingly when Asia and the Middle East are increasingly codependent?
We have time for one more question. Did you have a question? No? Any other questions? Okay, right here.
Yeah, I was interested in your comment.
Oh, I'm sorry, we're going to have let's give you a microphone.
Oh, okay, yes. So my question is about your comment about shale gas being produced outside of the United States. And of course, shale gas revolution has been what everybody's been talking about for a while, as you said. But you also mentioned China as shale reserves, and they're beginning to deploy the technology. I heard that Russia's done some as well. So I'd just like to get an update from you on where that's going. And given that we're looking at peak demand, what are the implications? If there's not going to hit peak demand in China, then I could see them expanding their resources from shale quite a bit.
I mean, very, very quickly, I mean, because we're running out of time, I guess. Shale gas the revolution hasn't been replicated outside the world, but the country that comes close to it is Argentina and Vaca Muerta. And then China, of course, has this huge resource, available. But again, it's mostly in the Sichuan Basin where the geology is very difficult. The U.S. was successful because there's a lot of independent companies competing for each other. Technology was there. Prices became economical, and the shale gas kind of happened. In China, you got the multinational companies being kind of directed by Xi Jinping to produce as much as they can. So the competition of the market dynamic of the shale gas revolution is not there. Water is an issue. There are many issues in China, but the potential is there, and we think eventually Chinese gas demand will grow. Shale gas, even coal bed methane production in China will grow. Pipeline will grow. China's a big economy, big energy economy, so they will use all of the above.
I think the thing that's also interesting when we think about replicating shale in different parts of the world is when you think back to earlier this decade or even late last decade, when the shale boom was just in its infancy here in the U.S., you saw countries or companies from like Chinese oil companies, Chinese gas companies, come into the U.S. or come into places like Canada to try to form these joint ventures, to try to link up, understand the expertise, understand the geology, understand the technology, take it home and do it. If there's any country on earth that would throw money to make a problem go away, it's probably China, right? But the idea that we're now a decade into this, a decade more into this, and China's still in such an infant stage in terms of their shale production. I think is very meaningful because, you know, when it comes to deep pockets, they have deep pockets. When it comes to engineers, when it comes to expertise, when it comes to technology, that's all there. So we also have to think about, you know, the EIA will put out reports talking about how there's significant shale deposits there, but geology's not all homogeneous, right? So I think that all has to be taken into consideration as well when we think about all the different variables.
I know that there probably gets more questions, but it's 8 o'clock. I just want to say, you know, when Go and the Japan Society reached out about doing this panel, I was so thrilled for the opportunity, and I was just absolutely delighted to have the opportunity to be in conversation with Go, Mike, and Catherine, because they are, in my opinion, absolute energy superstars. And as I'm sure you all are leaving tonight with the same opinion, they really are just so clear in helping to explain a very, very, very complex series of issues. So very grateful to have the opportunity. They made my job very easy. I could just sort of throw out a question and just phenomenal responses. So, and thank you all for being here. Many thanks to the Japan Society for hosting, and there is a reception outside, so hopefully the conversations will continue. Thank you all very much.
Thank you.